If you go back to 2022 and you conduct a survey asking people what they think the overall US economy will be like in 2023, I would argue that most people would have said that we would be in a recession, or at least some kind of negative view on the overall US market, whether it's housing, jobs, the stock market, really anything. But in reality, it's now June, we were halfway through the year, and the case for a recession this year is just crumbling away. The thinking here was the US economy would grind to a halt because the Fed was effectively slamming the brakes to squash inflation. Now, the Fed did, as we all know, raise rates pretty aggressively. They're now sitting at 5 to 5.25%, but the economy is still resilient. Hiring unexpectedly accelerated again last month, with employers adding an impressive 339,000 jobs in May. The economy is incredibly resilient, despite the banking crisis, rate hikes, the debt ceiling crisis we just went through. Despite all of this, the S&P 500 is now officially in a full swing bull market. And the criteria to officially be a bull market is the index has risen 20% or more from its most recent lows, which were back in October of actually last year. It also appears that for the moment, rate hikes might be done. These are the probabilities for the next meeting, and there's a 72% chance that there's going to be no change and a 27% chance that it's going to be another small 25 basis point increase. So the market certainly likes this, the idea that rate hikes are now done. But going back to the recession idea, which has a bigger impact on the market, there's just very few indicators at the moment that we are about to enter into one. So some things we would be looking out for is a contraction in the GDP, low industrial output, growing unemployment, and an inverted yield curve. We certainly do have this last one, the inverted yield curve. It's been heavily inverted for a long time now, and historically that would indicate a recession, although not always. Other factors like unemployment is nowhere near recessionary levels, and there's also no sign of a GDP contraction going on. And to prove that, we can look at the SCI, which is a combined index score published by the Fed to approximate the health of each individual US state. So being that this looks at individual states, it could give us a heads up if we see more and more states begin to contract of a potential upcoming recession. But right now, 0 states are experiencing contractions. So it looks like the economy, despite all of the predictions, is healthy right now. If anything, the most concerning thing to me right now about the stock market is this most recent impressive bull market, this rally. It's not that broad throughout the market. It's concentrated in the largest tech companies. Most of the gains in the S&P 500 this year have come from just a small group of stocks, which critics say is unsustainable. Apple, for example, is up 30%, Microsoft 44%, Alphabet 25% this year. And we can view this in a visual way using this S&P 500 map. If we filter by year-to-date performance, we can clearly see how the large tech names have been driving this bull market and everything else has been kind of left behind. So this concentration is a little bit alarming. I think it's highly likely these companies will have some kind of a cool-off period. But as long as the overall economy continues to be healthy, show resilience, there's no reason why eventually, later on this year, maybe next year, this bull market can't become more widespread and filter down to other smaller companies. So if you invest in anything other than large cap tech, say you're a dividend investor, that's probably why you've been missing out on these massive market gains. So while the S&P is up 7%, tech is up 21%, SCHD is down 2.5%. And I think, my opinion, not financial advice, this creates a great buying opportunity for these value dividend companies. If the economy does turn south and we enter into a recession, everything is going to get hurt across the board. But if the economy is more resilient than people think, which so far has been the case, eventually this bull market will trickle down to everything else. After all, a rising tide lifts all boats. And there's a chance in the very near future that these low price levels of value companies might not remain so attractive. And that's why just today, Friday, I put another $1,000 into these beaten down value plays. So I'm trying to take advantage of this dip in value companies, but overall, because I am well diversified across growth, value, and broad market indexes, my portfolio has been doing great, and we're just about to hit $52,000 balance. So I remain optimistic on the general outlook of the US economy, and I'm buying value stocks right now. Let me know what you guys think in the comments below. If you're still watching and enjoyed, leave a like, subscribe, and I'll see you guys in the next one.